Let's switch focus though. We have Mr. Girish Kousgi, MD and CEO at PNB Housing Finance. Let's pull up the stock. Was doing fairly well at the start of trade. Is it still doing well? Let's have a look at that. There you go. Fairly well. 5% higher on a day like this. No complaints whatsoever. Mr. Kousgi, let's talk about growth. You've guided 15% plus kind of growth. How achievable is that? You've also ventured into the affordable housing finance segment. How much will that contribute to your growth? And for how long can you do this?
Good morning, Harsh. We have guided 17% and we have already reached 16.2.
Yes.
So if you look at the last quarter, it was 14.4 and last year was 14.1. Last to last year was 10. So against a guidance of 17, we're at 16.2 and we have two more quarters to cover, 0.8%. I think we would be able to easily cover that. So I think growth plan is intact. And this change in segment is also helping us on maintaining the NIMs. So this growth is going to stay for next 3 to 4 years time at least.
Yeah, you've done very well on margins. You've guided for 3.5. You're currently clocking 3.7. It can only get better from here as you do affordable housing as well. So those levers intact. So margin guidance, would you care to increase that for FY25?
No, we would not want to increase the margin guidance, for the simple reason for next 2 to 3 quarters time, we'll be able to maintain between 3.6 to 3.65. And after 3 quarters, because of change in mix more towards high yielding segments like affordable and emerging, after 3 quarters, margins will start inching up. So at this point in time, we stick to our guidance of, it used to be earlier 3.5. Now we are saying we'll be able to maintain the margins between 3.6 to 3.65. And after 3 quarters, it will start inching up because the story on affordable is very good. We started this 22 months back. The first month was 5 crores. We have crossed 3,000 crores in 22 months on the affordable side. And emerging, we reached a book of about 12,500. So I think it is really trending well. Margins are improving. And I think great story ahead on both affordable and emerging.
And how long would you offer this mid-teens to around 17% growth guidance for? Do you believe it's for the foreseeable future? Do you believe it's for the next 2 years and on the higher base you may temper growth? How do you view that?
I think market is very good. We are doing pretty well. Even if you look at last quarter one for us was very good, given the cyclical trend which we witness, in a year, quarter one is generally muted. For us, it is very, very good. And quarter two obviously is a lot better than quarter one, and quarter three and quarter will be very good compared to quarter one and quarter two. So this year we have guided 17. We're at 16.2. I think probably next year, even if you continue the same trend, I think it should be much better. I think for next 3 to 4 years time, PNB Housing will see very good growth on the retail front.
Okay, so good growth on retail. Any focus on corporate?
Yeah, corporate now the book is 1,500 crores.
Yes.
Total book is about 69,500. Out of that, retail is 68,000 crores approximately, which is 98%. Corporate is 2%.
Yes.
And we will be starting corporate in maybe in quarter 3. And that should help us on both growth as well as margins. And corporate would always be low focus for us. In terms of portfolio mix, it will be less than 10%. It will be yield accretive, and we would stick to a very safe, sound, a book building process. And this would build in the next 3 to 4 years time, and we'll keep it less than 10%.
And sir, talk to us about OPEX trends. You're planning to expand to 500 branches. How will OPEX therefore trend? Your OPEX has gone up by 20% on a year-on-year basis.
So if you look at OPEX, I think 2 things are there. One is on the income side, because we are not doing corporate and corporate book is depleting, that has a bit of impact. But today, if you see the total PAT, 80% of it comes from retail. Once we start corporate, and from now for next 3 years, we'll be on an expansion plan. We plan to open about 50 odd branches every year from now till next 3 years. So by FY27, we will get to 500 branches. Largely, it will be on affordable and to a small extent on emerging. In terms of OPEX to ATA, we are now between 1 to 1.1. We'll be able to maintain that for next 3 to 4 years time.
Right. And so right now, a lot of your, your costs are getting insulated because there are no credit costs flowing through. What's the kind of credit cost number that you would look at on a normalized basis? Currently negative, and therefore aiding your numbers, and therefore OPEX can be elevated. I believe that that's the strategy. What happens when credit cost starts to trickle through and normalize? And where will that number be at?
So for next 1 year, credit cost standalone is going to be in single digit. With recovery, of course, it will be negative. And on a long-term steady state, credit cost is going to be around 30 bips.
Okay, very focused, point taken. And with regard to, therefore, profit growth, you'll do 17% on loan growth, roughly. And therefore, profit growth easy to do 20% plus?
I think if you look at last few quarters, our PAT growth has been over 20%. I think we'll be able to maintain that. And with change in mix, with the restart of corporate, with better control on collections and recoveries coming in, because we still have 1250 crores pool on the corporate side, which is written off, and we have 500 crores on the retail side. With all of these four, one is starting corporate, retail growth, changing segments more skewed towards high yielding. Definitely, PAT will be maintained. It will be in excess of 20 odd percent.
Got your point. What happens when rates come off, sir? You are being conservative by giving a 3.5% margin guidance. Rates come off, that's only going to help you likely. There's going to be a lag, of course, but likely?
So there'll be a lag. I think this is quite true for the entire industry. So there'll be a lag effect. I think given our context, I always keep saying that for next 2 to 3 quarters time, no, we'll be able to maintain this. In the scenario of rates coming down, there'll be a lag effect and there'll be some impact. Impact for us is going to be lower for the simple reason we will be starting corporate. And number two, if you look at the mix of affordable and emerging, today it's already 23% on the portfolio, retail portfolio. And if you look at quarter two, the contribution is 31%. We will take it to 40% by this year end. So I think with every passing quarter, our contribution or origination from affordable and emerging is going to come at a higher yield, and that is going to kind of offset to a large extent. There'll be some pain, but that pain is going to be minimal for us, in case the rate goes down.
Okay, point taken. Thank you so much, Mr. Kousgi. Of course, for a very strong quarter, many congratulations, and wishing you all the very best for H2 FY25. We'll continue interacting with you, of course.
Thank you.
Okay, all the time we have, out of time on this edition of SMID from